Good evening, everyone. Can you hear me? Good evening. Shall we start the session? Okay. Okay, today we are having another question. Today I'm going to focus on the second method of preparing these consolidated financial statements with complex group structure, which is to be the fair value method. Last week, in the last session, we discussed the proportionate share method. Today I'm going to discuss the fair value method. Okay. For this, I have a question. I have uploaded this to the LMS as well. The draft statements of financial position of three entities are given. We have the assets, equity and liabilities, and we have actually without the adjustments we are going to discuss today also. From next session onwards, we are going to discuss with additional adjustments. Now, according to the given information, P company acquired 70% of the holdings of S company on 1st Jan 2020, when the reserves of S stood at rupees 50 million, and S company, it's 80%. Okay, give me a minute. Sorry for the disturbance. Now, P company have acquired S company 70% of the ordinary shares of S company, and S company has acquired 80% of the ordinary shares of SS company on 1st Jan 2020, when the reserves of SS stood at 60 million. Yes. And it's the group's policy to measure the non-controlling interest at fair value at the rate of acquisition. And the fair value of the non-controlling interest on 1st Jan 2020 was 50 million, and the fair value of the non-controlling interest in SS on 1st Jan 2020 date of acquisition was 100 million. These are the information provided. Okay, now quickly prepare the workings. We are going to need two COC accounts. Now you are aware of the required accounts. Okay, we are going to need Yes. We are going to need two COC accounts. COC for S company, COC for SS. Then we need to prepare the stated capital of S company, then the stated capital of SS. Then we are going to consider the retained earnings of S and the retained earnings of SS. Then we are going to need to have the consolidated retained earnings account and the NCI account. These are the basic accounts that we need to provide. Okay. We have three entities: entity P, entity S, and entity SS. Entity P has acquired 70% of the ordinary shares of entity S. Entity S has acquired 80% of the ordinary shares of SS. Okay, quickly tell me the effective interest and the NCI. This is then vertical arrangement. Having only an indirect control over its subsidiary. Quickly tell me the effective interest and the NCI. Now you're familiar with these things. Good. Okay, NCI. %70% of 80%. 56%. Okay. The effective interest is 56%, therefore the NCI is 44%. The effective interest is 56%, therefore NCI is 44%. Okay. Then we look at the investments. Entity P has made an investment in entity S, 130,000. Okay, when it comes to the consolidation, we are preparing the consolidation on behalf of the parent, and the parent has made an investment of 130 million in entity S. Then when it comes to the ownership, the parent has the full ownership and the control of this particular investment. Therefore, investment account credit, the ZOZ debit 130,000. Investment account credit, COZ debit. Then with the second investment is made by whom? The second investment is made by entity S. The second investment is made by entity S. And sorry for the disturbance. Now, when it comes to the second investment, who does own this investment? S company has made an investment in SS 120 million. Who does owns this investment? Quickly tell me. Who does owns this investment? This investment is owned by S company. But S company is controlled by whom? This company is controlled by P company. S company is controlled by P company. Up to how much? Up to 70%. Up to how much? Up to 70%. Is it clear? Yes. Therefore, in this consolidation, we need to consider the investment total amount. The total investment is 120 million. Out of this 120 million, parent owns only 70%. Parent owns only 70%. This into this. Yes. It's, as you correctly mentioned, it's 84 million. 84 million. Then what will happen to the balance amount of the investment? Who does owns the balance amount of the investment? The balance amount of the investment is owned by the NCI. The balance amount of the investment is owned by the NCI. Okay. Then investment account credit, NCI account debit, the balance amount. 120,000 minus 84,000. Now, this is in millions, 36 million. Okay. That is for the investment. Then, under the proportionate share of proportionate share method, we had to take the proportionate share of the NCI to the COC. We had to take the proportionate share of the NCI to the COC. But under the fair value method, no such additional calculation is needed, as the fair value or the actual value of the NCI is given at the date of acquisition. Within the acquisition date එකට අපිට NCI වල fair value එක දීලා තියෙනවා. NCI වල fair value එක දීලා තියෙනවා නම් අපි ආපහු book value එකට additional calculation එකක් කරන්න ඕනේ නැහැ. We do not need to do such kind of additional calculation. What we can do is we can take this fair value directly to our accounts. We can take these fair values directly to our accounts. Then when it comes to the fair value of NCI at S, at the date of acquisition, it stood at 50 million. It stood at 50 million. Then COC account debit 50 million and the NCI account credit 50 million. COC of entity is 50 million. Okay. Is that part clear to you? As we are being given the fair value of NCI, we can take the total amount directly. That's the only difference. Actually, when it comes to the fair value method, it makes our life easy. We do not need to go for an additional calculation. Is it clear to you? ඒක තේරුණාද ළමයි? අපි කලින් method එකේදී additional calculation එකකින් තමයි NCI value එක හොයාගත්තේ. But now in this case, as the NCI value is given, we can take the total amount directly. Okay. Then when it comes to the NCI of entity SS, it is 100 million. We can take that total amount, 100 million. COC of SS debit, NCI credit. $100 million. Okay. Now, on the debit hand side of the COC, we have the actual value of the entity. We have to compare this with the book value and calculate or get at the goodwill or gain on bargain in purchase. This is the market value of this entity, the amount the investor paid and the fair value of the NCI. We have both on the debit side of the COC. And then we need to compare this with the book value. Then when it comes to the brought forward value of the stated capital of S entity, we have 120 million. And the brought forward value of entity SS, yeah, can you explain it again? Which part you need me to explain? Yes, when it comes to the NCI at proportionate share method, what we did, we had to go for an additional calculation. We took the stated capital balance at the date of acquisition and we took the retained earnings balance at the date of acquisition, and we did some calculations of the percentage with the percentage of the NCI and took the NCI value, the percentage value, to the COC. Could you remember? That's what we did in the last session. As we did not had any actual value or fair value of the NCI with us. But now in this case, as we are following the fair value method, the fair value of the NCI is given to us. It is known to us. Therefore, no need of going for an additional calculation. We can take the given value or the fair value as at the date of acquisition to our COC and the NCI accounts. Okay. Then we'll take the stated capital now, as we have the 100% of the market value in the debit side. We can take the book value. We transfer this to the COC of S, 120 million. COC debit, stated capital of S, 120 million. Okay. Then we take the brought forward balance of the stated capital of SS. The brought forward balance of the stated capital of SS is 120 million, again the same amount, 120 million. Stated capital account debit, COC of SS, 120 million. Then COC of SS, stated capital of SS, credit, 120 million. Okay. Then we come to the retained earnings. First, we'll take the brought forward balances. Retained earning of entity S, 180 million. Retained earning of SS brought forward, 130 million. Okay. And the retained earnings of the parent brought forward balance, 200 million. Okay. Then when it comes to the subsidiary and sub-subsidiary, in their retained earnings, we have two portions. We have the pre-acquisition retained earnings and the post-acquisition retained earnings. What shall we do with the pre-acquisition retained earnings? Yes, we need to credit it to COC, and no, that's the case this is why I asked this question. Now, when it comes to the pre-acquisition retained earnings, this represent whatever the retained earnings balance stood before the acquisition. Now, when it comes to the before the acquisition, did we had any NCI and the parent before the acquisition? Acquisition එකට කලින් තිබුණාද ළමයි? NCI එකකුයි parent කෙනෙකුයි එහෙම දෙකක් තිබුණාද අපිට acquisition එකට කලින්? I'm asking this question from the student who gave this answer. Divide to NCI and COC. No. අපිට acquire කරන්න කලින් ළමයි දෙකක් තිබුණේ නැහැ මෙහෙම. entity කියන්නේ NCI parent කියලා දෙකක් තිබුණේ නැහැ. The parent and the NCI only become active soon after the investment made by the parent. Before parent make this acquisition, the total amount is owned by the NCI or the other shareholders. Yes. Therefore, when it comes to the pre-acquisition retained earnings, if there's no any adjustments which are needed to be done prior to the date of acquisition, we can take the total amount directly to the COC. Acquire කරපු date එකට කලින් profit එකට හරි retained earnings වලට හරි මුකුත් adjustments නැත්තම් අපිට පුළුවන් මේ total amount එකම directly COC account එකට දාන්න. We can take that total amount to the COC account. Is it clear to you, the student who gave this answer? Okay, good. Then we can take out the pre-acquisition retained earnings and translate to the COC of S. The pre-acquisition retained earnings of S entity stood at 50 million. We take out 50 million as the pre-acquisition retained earnings and we translate to the COC. Retained earnings of the S entity. 50 million. And we do the same for the assets, the sub-subsidiary also. COC of SS, the pre-acquisition retained earnings or the retained earnings at the date of acquisition stood at 60 million. We take out 60 million and translate to the COC. Okay, now we have the investment in CI on the debit hand side and the stated capital and the retained earnings on the credit side. Okay, now we can compare and calculate the goodwill or the gain on bargaining purchase. Quickly calculate the goodwill or the gain on bargaining purchase of these two investments. Yes, haven't I done it? Yeah, I have done it. Okay, give me a minute. Okay, I'm getting a call. I'll provide the answer for this one. Sorry. Yes, regarding this 36 million. Now, when it comes to this 36 million, what happened is, now when it comes to the second investment, the second investment is made by the entity S to acquire entity SS. This 120 million, the second investment, is with entity S. Is it clear to you? Okay, then when it comes to the investment done by entity S, as entity P owns only 70% of the ordinary shares of entity S, entity P can entity P have the right or the ownership only up to 70% of this investment. The balance amount is with the NCI. That's why we took only 70% of 120 million to the COC and transferred the remaining balance to the NCI. Is it clear? අපි එතන මිලියන 84ක් ගත්තේ මේ 120 මිලියන් වලින් 70ක් විතරයි. ඉතුරු 130 අපිට දෙන්න වෙනවා NCI ට. Is it clear now? Okay. Okay, then the goodwill. I think we have two goodwills. One of you gave the answer. Yes. We have a goodwill of 10,000 with the investment of S. And we have a goodwill of 4,000 with the investment of SS. Yes, good. Okay, now the remaining retained earnings, the post-acquisition retained earnings. Now, when it comes to the post-acquisition retained earnings, it should be divided among the consolidated retained earnings or with the parent and the NCI. The parent's portion should be transferred to the consolidated retained earnings, and the remaining balance should be transferred to the NCI. Okay. Sorry. What happened here? I can see the previous calculation. Okay. I'm still in the previous calculation. Consolidated retained earnings and the NCI. Okay, let me know the balances, the amounts to be should transferred. Mm, I got a different balance, 104 and 26. Why is it? I got a different balance. Can you recheck? Okay, when it comes to the post-acquisition retained earnings, total retained earnings is 180 million. We already took out 50 million as the pre-acquisition retained earnings. Yes, that answer is correct. Hmm? Okay, why you are taking 80%? Now, this is another mistake you're making. Even at the examination, you do the same mistake. Now, you have the knowledge, but you're taking figures wrongly. See, this simple mistake will lose all the marks, all the remaining marks. Yes. Oh no. That's why we need your practice. See, you have taken 80% instead of 70%. It's a very simple mistake, only 10% mistake, but you will lose whatever the remaining marks. Okay, we have to take 70%. And the remaining balance to the NCI. Then 91 million to the consolidated retained earnings and 39 million to the COC. Retained earnings of S. $91 million to the COC. It's 39 million. Okay. Now let me know of the two figures of retained earnings of assets. Yes, your answer is correct. Now, when it comes to the retained earnings, pre-acquisition, post-acquisition retained earnings of assets. Now, when it comes to the post-acquisition retained earnings of assets, we have to take whatever the remaining balance as the post-acquisition retained earnings. The original balance, brought forward balance to that 130 million, but we already took out 60 million. We already took out 60 million. Then as post-acquisition retained earnings, 70 million is remaining. From this 70 million, now we have to take the effective interest as we are going from assets to parent. Now we are going from assets to parent. Therefore, we have to take the effective interest, 56% to the parent and 44% to the NCI. Okay, is it clear? Okay, now quickly tell me the total asset and the total equity and liabilities. Quickly tell me the total asset balance and the total equity and liability balance. SPP, we have in 150,000, 130,000, and 200,000. We have altogether 140 million SPP. Then as goodwill, we have 10 million plus 4 million, altogether 14 million. Then as non-current assets, so as current assets, we are having 90 million, 80 million, and 70 million. Altogether 240 million. Then total assets, 734 million. Yes, total assets 744 million. Then as equity, the equity balance of the parent, the stated capital 100 million. Okay. Then the consolidated retained earnings, we have 330 million 200,000. And as NCI, we have 138 million 800, sorry, 183 million 800,000. And as liabilities, 70, 30 plus 20. Around 20 million. Balance at 734 million. Okay. Can you please explain how did we get PPS 180 million? Okay, according to the given information, as there's no any adjustments, the property, plant and equipment balances are 150, 130, and 200,000. Now we follow the line by line basis. If we take the total of this particular line item, property, plant and equipment, it totals to 480. 150 plus 130, 280 plus 200,000, 480 million. Is it clear? Okay, now we have a task. It's a similar type of question we are having here. Now, this is a D shape or mixed group structure with fair value, NCI fair value. This is a mixed group structure with NCI at fair value. Can you quickly prepare the answer? First, tell me the goodwill or the gain on bargain in purchase of these three investments. Now we are having 1, 2, 3 investments in here. How to identify the group structure? Whether is it a vertical group or a mixed group? What are the indications that we are having? Yes, this is a mixed group. How you say so? If you look at the this one way, if you look at the summarized statements of the financial position, here we can see when it comes to the investments made at entity SS, both the parent and the subsidiary have made investments. Both the parent and the subsidiary has made investment in the third entity. Therefore, parent has a direct investment and indirect. That's just an indication. This can be identified with the percentages. 80% of the ordinary shares of S and 10% of the ordinary shares of SS is owned by the parent. then without any doubt, entity P has the control over entity S with this 80% ownership of the ordinary shares. Okay? But at this time, up to this point, entity P has only 10% investment in entity S. But along with the details, it says that entity S also holds 70% of the ordinary shares of SS. Then entity P has the indirect control also over entity SS. Then entity P has both direct and indirect control, indirect investments. Therefore, we can identify this as a mixed group structure. Okay, only one gave me the answer. How about the others? I'm waiting for at least another 2 to 3 students. We'll have to check these answers. I have got the same answer twice for the effective interest and the NCI, but there are some mismatches with the answers I'm getting for the goodwill values. Okay, quickly tell me the goodwill values. Two have gave me two different answers. A, how about SS? A completely different answer. Okay, we'll check this, we'll check this, we'll check this. To COC. Stated capitals. to retained earnings. Okay, then we look at the group structure. We are having three entities. As we have an indication of a mixed group, we'll type it like this. Okay, entity P has acquired 70% of the ordinary shares of entity S. And 10% of the ordinary shares of entity S. And sorry, am I correct? It's 80%. And entity S has acquired 70% of the ordinary shares of entity SS. Okay, now when it comes to the effective interest, we are having a direct investment of 10%. We are having a direct investment of 10% plus 80% into 70%. This is how we take the effective interest when we have both direct and indirect investments. Therefore, the NCI is 34%. I got this answer correct. Okay, how about your answers? Please check your answers. Effective interest is 66% and therefore the NCI is 34%. Do you have anything to clarify with this one? 66 years. Now I got this 66 like this. We have a direct investment of 10% here. The parent has two investment. We have a direct investment of 10%. Then we can take it as as whole 10% plus this 10% investment plus then the indirect way 80% of 70%. 80% of 70%. That's to be how much? 56%. 56% plus 10%. Altogether, entity can effectively control 66%. Is it clear? Okay, good. Therefore, the NCI is 34%. Okay. Then we'll look at the investments. Investment in S. In entity S, there's only one investment made by the parent, 650 million. Sorry, 650,000. In entity S, there's only one investment made by the parent, 650,000. We'll take this 650,000 investment, 650,000, 650,000. As this was made by the parent, we can take the total amount. Then when it comes to the SS, we have two investments. One investment made by the parent, 50,000. Okay, again, as this investment is made by the parent, we can take the total amount. Investment account credit, COC account debit. As this is being done by the parent, 50,000. But when it comes to the second investment in entity S, this is made by entity SS. So when it comes to the second investment of entity SS, this is made by entity S. It's the other way around. Sorry. Yeah. For this 50,000 investment, as this investment is made by the parent himself, we can take this total amount to the COC of SS. We can take this total amount to the COC of SS. Then as the second investment is made by entity S. Now the second investment is made by entity S. The invested amount is 120,000. Invested amount is 120,000. Then out of this 120,000, how much is owned by the parent? Only 80%. Only 80%. Yes. Then 120,000 into 80%. 96,000 to the COC, and the remaining balance to the NCI. To the NCI. The remaining balance is 24 million. So 24,000. 96,000 to COC of SS. The remaining balance 24,000, which will be equivalent to 20% of 120,000 to NCI. Is it clear? Okay. Then we need to take the fair value of the NCI. The fair value of the NCI of S at the date of acquisition was 75,000. Here it's 75,000 and COC debit, NCI credit. And the fair value of SS 85,000. COC debit, NCI credit. $85,000. Okay, now we look at why you got two different answers for the goodwill. Okay, retained earnings, sorry, stated capital, the balance brought forward 420 and 420,000 and 100,000. And the retained earnings brought forward balances 430 and 120. Okay. Then we have to divide these to pre-acquisition and post-acquisition. When it comes to pre-acquisition retained earnings of entity S, the pre-acquisition retained earnings is 210,000. Then we can take out the total balance and transfer to the COC. The pre-acquisition retained earnings 210,000. Sorry. First we'll transfer the stated capital first. The total amount we can transfer. Here also we can transfer the total amount 100,000. Is it clear to you? the transfer of the stated capital. It's very simple. Then the retained earnings. Sorry. Here we are having the pre-acquisition retained earnings, 210,000. And here we are having the pre-acquisition retained earnings. How much? 70,000. Why did you get two different answers for this? Means we are having a good view. $95,000. You got this answer correct. But when it comes to this one, you got a different answer. 231, 231. And the goodwill. $61. Can you please recheck your answers? I got some different answers from different students. Like students who gave those different answers, can you recheck your working? What happened? Hmm? Okay, good. Some of you have prepared this. Okay. One of you didn't get 15 before. Okay. Yeah, when it comes to the mixed group structures with the subsidiary, we need to consider the both investments, the direct investment made by the parent and its indirect investment via the subsidiary. In the COC of subsidiary, we have to take two investment balances when it comes to a mixed group structure. We need to take the direct investment made by the parent and the portion of the indirect investment made through the subsidiary. Is it clear? Okay. Now, rest are the same. Now we are going to consider the post-acquisition retained earnings should be divided among the consolidated retained earnings and the NCI. Okay. We had 430, but we took 210,000 out of it. From this, 80%. to the consolidated retained earnings. And the balance to the NCI. To the consolidated retained earnings, the brought forward balance of the consolidated retained earnings is $1.5 million. Retained earnings of S, 176,000. NCI, retained earnings of S, 44,000. Okay. For the post-acquisition retained earnings of entity S is, now we have to take the effective interest, 66%, 33,000, and the remaining balance to the NCI. Okay. Then in consolidated retained earnings from SS, it's 33,000, and the NCI, it's 17,000. Okay, now good. We'll check that one also. Then as non-current assets, we have 1,004, 730, 220. Okay. Then the goodwill, $95 plus 61, 156. Okay, that represents the total assets. So I got, let's see. Okay, we'll see the equity, the stated capital, 600. My consolidated retained earnings, NCI. Yeah, we take the same answer. Okay, have got the same answer. Good. Okay. That is how to prepare the consolidated statement of financial position under the fair value method for vertical group and mixed group. Okay, now I want all of you to attempt test number 3 and provide me with these answers. Only these balances change. It's 20%, 70%, and 90%. Is the effective interest 83% and the NCI is 17%? Is this the answer you got? Okay. Then the goodwill balances, is it 95,000 and 49,000? Okay. Eh, Tell me the answers. 95 and 61? No. Should be 95 and 49. And these are the consolidated retained earning balance and the NCI balance. You can write it down and check your answers. And on next week, we'll move on to some advanced calculations with adjustments. Okay? You will get a question like this for your final evaluation. Therefore, on next week, you are going to do a similar question, like a model question. Yeah. This is the consolidated retained earnings balance. Consolidated retained earnings balance 1,695,500. And the NCI is 344,500. Okay. Oh yeah, NCI is 198,500. These answers are correct. Okay, then we'll meet on next week. I will try to take the next session as a physical session, okay? But can't guarantee. Now, if I'm taking a physical session, I will put the message on the LMS. Okay. Okay, then tomorrow, for which subject? Yeah, we are having the lectures. It's not one of the department events. We are having the lectures, okay? Just better to talk with the respective lecturers. Okay. Yeah, anyway, you need to participate for those kind of activities also. Better to talk with the respective lecturers, okay? Yeah. Okay, thank you. Good night.
Recording